Hello everyone, Mariko Berg, residential realtor with the Bridgewell Real Estate Group, and welcome back to the Bridgewell Group YouTube channel where I talk about all things real estate, specifically in my local area, which is the Greater Vancouver and Fraser Valley of British Columbia, Canada. But I also cover BC-wide things, I cover federal things, and so definitely make sure to subscribe if you haven't already for content related to all of that. So being a realtor, this video is going to be tailored to real estate and specifically like disposition of real estate. But starting off, like what is capital gains and when does it apply? Technically, it can apply to the earlier of three different scenarios. So one being you sell an asset like a house, you leave the country and you depart Canada. That can be considered a deemed disposition. Or you pass away and you leave the asset to someone other than your spouse. Now, it's important to know that there is like tax planning that you can involve with your accountant or financial advisor. There's, primary residence exemptions. And so there are things that could negate this capital gains tax, but that is primarily what is going to be considered a deemed disposition. So when we're dealing with capital gains, what's happening? They are taxing the gain. So the inclusion rate is a term that is used to describe how much of that gain is being taxed and added to your taxable income. So before we get into this example, I just want to go over what are the key changes to the capital gains tax. So we have to separate this into personal taxes, whether you've purchased the property in your personal name or whether you've purchased the property through a corporation like a holding company, something like that. Now, first off, if we are dealing with you purchasing the property in your personal name and capital gains applies, so for example, an investment property, prior to the 2024 federal budget announcement, so prior to it coming into effect as of June 25th, 2024, the inclusion rate on all capital gains was 50%. Now, after June 25th of 2024, the inclusion rate on all capital gains profit below $250K is still 50%. If you own this property in your personal name, but anything in excess of $250,000 is now taxed at a 66.67% inclusion rate. So basically went from 50% all now to 2/3 for any excess profit above $250K. Now, if you are a corporation, so like I said, a holding company is a great example. Prior to June 25th, 2024, it was just all 50%. This was the norm for everybody, regardless of whether it was personal or corporate. Now for corporations, they do not get this $250K tax break. They just have the whole amount with a 66.67% inclusion rate or 2/3 inclusion rate on your capital gains. So that's where you always have to start is just, have you purchased this investment property or is there like a deemed disposition on this property? Is it under a personal name or is it under a corporate name? So moving on to an example, let's just break down the scenario first. So let's say this is an investment property that was purchased under a personal name. It was purchased for $1 million. And now, however many years later, they're going to sell it for $1.5 million, or they have sold it for $1.5 million. So what's the gain? 1.5 to 1 million. Let's just like not really factor in like closing costs or anything like that. Let's just say the gain is 500,000, okay? So here we are going to assume a marginal tax rate of 53.5%. So that I can give you the numbers on like how much this is going to affect someone. So again, we've got a $500,000 total gain. Because it's in a personal name, we have that $250K shelter, quote unquote. So for the cap gains under $250K, you take the $250,000 number and you times it by the 50% inclusion rate, and that comes to $125,000 in taxable gains for that first $250K, right? Now, because there was $500,000 in profit, we have to take the capital gains that was over $250K. In this situation, it was also 250K. 250 plus 250 equals 500. So for this amount above 250K, that is multiplied by the higher inclusion rate, which is the big change that's happening as of that June 25th date. Now we're multiplying it by 66.67% inclusion rate, and that comes out to a taxable gain of 166,675 for this upper portion. So we can add these two together, 125K, 166,675K. That comes to a total taxable gain on this particular scenario to 291,675. So if you are someone that wants to know like what this actually means in terms of how much profit you're losing, hypothetically, I think something we all love, I'm gonna do some calculations for you. So we're gonna go through a fun math equation. So again, I'm working off a marginal tax rate of 53.50%, okay? This is the marginal tax rate. So how do we do this calculation? We can start with like before June 25th, right? Before the 66.67%, and then after June 25th, right? So this is that 2/3 thing. So let's go off of this example, right? So we're working off a 291,675K taxable gain. So we'll just write that amount down. So $291,675,000 taxable gain. So I multiply that by 53.5%, right? So 291,675 times 0.5350 comes out to 156,046.125, okay? So what does that mean? That means that this is the amount of tax you're gonna pay. So you can take the 500K that you had made in profit before, you minus this 156,046, right, roughly. So we take 500,000 minus 156,046, and that means that we are walking away with $343,954. Not a bad situation necessarily, right? So this is a really great representation of a real life example that is in effect now. But let's take this same person before June 25th so that you guys can really understand what the implication of this capital gains tax is, right? So this is at 2/3, right? Before it was just everything was 50%, right? So that whole 500K, we can do this example a little bit differently now, right? So you make your profit of 500K, right? How do I figure out what my taxable gain is? I multiply that by 0.5. So that's 250K, that is a taxable gain, versus the 291K, which is a taxable gain, right? So this taxable gain has gone up almost $42,000. So obviously that's going to equate to more tax. So by this example, this is the taxable gain at the 50% inclusion rate. Now we take that 250K, right? And we do the same thing. We multiply it by the marginal tax rate that we've used as an example as 53.5%, right? So now do the calculations, 250,000 times 0.535 equals $133,750 in tax. So we take that 500K, and to figure out our profit, we minus that 133,750, and you come out with, I don't do math in my head, you come out with a profit of 366,250 in this 50% inclusion rate. And in the 2/3 inclusion rate, you come out with, for this particular example, again, factoring in the first 250K was 50%, and the second was 66.67%, you come out with 343. So how much profit are we losing? We are losing $22,296 in profit by switching over to this higher inclusion rate. So let's quickly take a different example, okay? I'm gonna move this for a sec, and let's go back to the board. So again, at the very beginning, I was telling you guys that it's different if you put it in your personal name versus if you put it in a corporation. So with the personal name, you get this tax break where the first 250K, nothing changes based on like pre-June 25th, post-June 25th, that 250K in profit is still just that 50% inclusion rate. Now, let's switch this and say that you had bought that property in a corporation. So, corporations, this is going to affect you for sure. So now there's no cap gains under 250K. So let's start this all over again. What does that mean? That means that we just use a flat rate. So we take the whole 500K in this exact same situation. All we've done is change it to corporation. And now the whole 500K is going to be taxed at that 2/3 or 66.67% inclusion rate. So what does that mean for our taxable gains? That now means that we just take a calculation of 500,000, we multiply it by 0.6667, and that means that we have a taxable gain of $333,350. Taxable gain. Big, big, big difference for the same like number-wise scenario, whereas now we have a taxable gain at $333,350. In the previous example, we only had a taxable gain of roughly $291K. So you can see that this really impacts the corporations that are in deemed disposition of a property and making profit off of it. Thank you so much for watching this video, and I hope that you learned a lot about capital gains and how these new changes affect you in Canada. Again, my name is Mariko. I am a residential realtor with my team Bridgewell Real Estate Group, and we help people buy, sell, invest all throughout the Greater Vancouver and Fraser Valley areas. So definitely feel free to reach out to me if you are looking to get into the market, sell, buy and sell at the same time, whatever it is, my team can definitely help you out. If you do have specific questions with regards to the capital gains tax and how it affects you, I would definitely recommend reaching out to your accountant directly, just because this tax stuff is so nuanced. And again, I'm not an accountant. They are definitely going to be your best resource moving forward. If you are looking for more information like this in the future, definitely feel free to subscribe to the Bridgewell Group YouTube channel. Again, I talk about all things real estate, both local to my market, provincial and federal. So definitely make sure to check out more videos in the future. Comment down below. I don't honestly usually do videos like this. So if you like it, I would love feedback on it and just information on what you're looking for in the future. And anything that you can do to like, subscribe, comment, support the channel really, really means a lot to us. So thank you so much, and I hope you have a great day. Bye.